And good afternoon. I'm Rick Edelman. Thanks so much for joining us today on this webinar, The Great Derisking, Why There's Never Been a Better Time to Buy Bitcoin. This is going to be a dynamic, fascinating conversation filled with a lot of statistics, fun facts, and the latest of what's going on in the world of crypto and particularly Bitcoin. And joining us, my good friend, Matt Hougan, who is the Chief Investment Officer of Bitwise Asset Management. Matt, always great to be with you.
Thanks for having me, Rick. Really excited for this conversation.
Matt has been in this industry for decades. He began in the ETF world 20 plus years ago, where he was one of the founders of Inside ETFs and ETFs.com, made the shift some years ago over to the crypto side, where he has been one of the principals since the beginning of Bitwise, the largest, oldest crypto-only asset manager in the industry. So, Matt, you know both sides of the fence, the TradFi world as well as the crypto world. You know, it's really fascinating. I've never seen anybody go from crypto to TradFi, but I've seen a lot of folks go from TradFi to crypto. Um, uh,
It's a one-way door, Rick. Those of us who have walked through it know which direction the world is headed, and we want to be on that side of the equation.
and I'm going to ask you one particular question about that, your viewpoint of some news that came out yesterday that I know you know what I'm referring to. But before we get to that, I would like you to share with folks who may not be familiar with Bitwise, tell us a little bit about the organization.
Sure, absolutely. Yeah, as you mentioned, Bitwise is one of the oldest, most established crypto asset managers in the world. We were founded in 2017, and we created the world's first and today the world's largest crypto index fund, which is called the Bitwise 10. It's currently available as a OTCQX traded closed-end fund style structure, but we're petitioning to move it to an ETF. Today, though, we manage over $12 billion in assets across multiple types of products, including a spot Bitcoin ETF. You can see us ringing the bell at the New York Stock Exchange in this photo. Spot Ethereum ETFs, SMAs, trend following strategies, active strategies, both in the US and in Europe. Our core goal is to serve financial advisors. That's how we built the business. That means we do research to help educate advisors about what's going on in the market. And we have the only nationwide distribution team in crypto. So person in every area of the country that's there to partner with advisors and help them gain exposure to the opportunities in crypto while avoiding some of the risks in the market. So that's us in a nutshell.
There's been three pieces of big news in just the last couple of days. The first I want to tease you with is Jamie Dimon, who in 2019 said that he would fire any trader who traded Bitcoin. And yesterday, he announced that JP Morgan will allow its clients to buy Bitcoin, a 180-degree reversal.
That's right. It's not the first one we've seen, though, Rick. Remember, Larry Fink called Bitcoin an index of money laundering and then called it an asset that could replace the dollar. If you go far back enough on Twitter, you can find Michael Saylor saying Bitcoin is a Ponzi scheme that will amount to zero. And now he's the second largest holder of Bitcoin in the world. So there is this history of people being opposed to Bitcoin and then grudgingly accepting it. And the next phase, Rick, that we've seen from Saylor, from Larry Fink, from others who have made this step from anti to grudging acceptance, which is where Jamie Dimon is, to full-throated endorsement. I think JP Morgan will get there. I think you're going to see their clients buy billions of dollars of Bitcoin. It's another sign that Bitcoin is moving from the edges fully into the mainstream. And, you know, as we mentioned, this is a one-way door. There is no going back. So JP Morgan is now and will forever be open for business for their clients to allocate to Bitcoin. It's a very good piece of news.
And let's keep in mind, of course, that if JP Morgan says this, the others have no choice but to follow. So Morgan Stanley and Wells and UBS, et cetera, they've all got to follow suit.
Yeah, and this is really an important point. They not only do they have to, they will, and they are. This was already happening. This JP Morgan is a part of a bigger story. But I think people who have been following this need to remember there's about $30 trillion of wealth that has not been able to buy the Bitcoin ETFs yet. And that is just opening up right now. That's what Jamie Dimon is saying. He's not going to custody Bitcoin, but he is apparently going to allow people to access it, probably through an ETF vehicle. As you mentioned, that's also happening at Morgan Stanley, at Merrill Lynch, at UBS, at Wells Fargo, at regional broker-dealers. I've been at two major broker-dealer conferences over the last month. They're greenlighting Bitcoin ETFs. So we've celebrated Bitcoin ETFs pulling in $40 billion in assets so far, but this is a snowball. It's just gathering momentum. I think those flows are eventually going to look small. I think we'll set a new record for flows this year. ETFs have pulled in $7 billion in the last month, Rick, in the Bitcoin space, and I think it's just accelerating.
And those flows, right, have to translate directly to increase in prices because we're talking about a fixed supply asset.
That's right. You know, Bitcoin, the beauty of Bitcoin is its price is set by supply and demand. And we all know the supply. We create 165,000 new Bitcoin every year. ETFs have already bought about 70,000 Bitcoin, and I think that's going to accelerate this year. Public companies have bought about 180,000 Bitcoin. That is more than the full annual supply. And when increased demand meets with fixed supply, you know, I didn't major in economics in college, but I think what happens there is the price goes up. I think that's how that equation works.
Yeah, I think all you need is common sense, not a bachelor's degree in that subject. Two other pieces of news. I don't want to spend a whole lot of time on them, but I just note that they're really interesting factoids. Number one, Coinbase was added to the S&P 500 stock index. This is normally I would think, okay, when a company is big enough that it warrants getting added, it gets added around number 500 or 450 or 475 because it's finally big enough to be among the 500 biggest companies in America. But Coinbase was added at number 157, which makes me think, obviously, the S&P committee waited a little too long.
That's exactly right. I mean, one of the things that's happening is that crypto was repressed because there was this reputational risk embedded in it. So you're absolutely right. Coinbase should have been added a year or two ago. Instead, they're finally catching up. But we're seeing in this Jamie Dimon news, in the S&P committee news, in the approval news at other wirehouses, that reputational risk is just being removed. Bitcoin is now being treated like any other asset. It's now a first-class citizen in the financial industry space, and that's going to lead to more flows, more price appreciation, more usage. So count this as another, brick in that wall of normalization.
And I've got one more for you. Before I mention it, I want to say to everybody that you have the opportunity to ask questions in this conversation. A lot of you already did. You've sent in questions with your registration, and I will pepper Matt with those as we go. You can add to the dialogue here. Just go to the Q&A box in here on Zoom, and I'll be looking at those as well. The third item of newsworthy, Matt, is that the Genius Act, the stablecoin bill, has cleared the panel, the subcommittee, and it is now headed to the full Senate. Just you and I in conversation just a week and a half ago, you were a little upset. I think we all were that a whole bunch of Democrats had raised a blockade against that bill. That seems to have disappeared already.
Yeah, absolutely. This is the second most important regulatory development in the history of crypto. The first most important, from my view, Rick, was the passage or the approval of spot Bitcoin ETFs. That normalized the investment into crypto. This is going to normalize the use of crypto in our day-to-day lives. So just to put a fine point on it, yes, we were frustrated a week and a half ago because you need 60 votes in the Senate to move these bills forward. And we thought we had that on stablecoins because they're a win for the government, for Republicans, for progressives. They're a win-win-win for America. It seemed insane that it wouldn't pass. But at the last minute, at the last vote, the vote failed because Democrats defected away from it, led by Elizabeth Warren, who raised this specter of crypto being tied with Trump in some sort of corruptive nexus. And I worried that we had just lost all momentum for crypto legislation. But kudos to the 16 Democrats who worked with the Republicans to revise the bill slightly, add some protections around foreign issuers and AML KYC, and now it's past that 60 vote hurdle. Now it just needs a simple majority vote on the floor of the Senate, which is going to happen in the next week, and then approval in the House and signature by Trump. And all of a sudden, stablecoins will be normalized in the US. That's going to mean every major Wall Street institution is going to launch a stablecoin. I think it means we'll start to pay with stablecoins. I think it means stablecoin AUM will go from 250 billion to 2.5 trillion in a couple of years. I think this will just normalize the use of crypto in our day-to-day lives. It means 1 billion people will have wallets on chain. I think it's a massive deal. I do think it's of the size of importance, particularly to Ethereum, Solana, and non-Bitcoin crypto assets, as the Bitcoin ETF approval was in terms of flows, in terms of its influence on the future. So I think it's a really big day.
So this seminar, this webinar is called the Great Derisking, and we just cited 3 events that have all occurred in the last 48 hours, let alone the last 12 months. So it just, I think, demonstrates the incredible speed with which this asset class is going from the fringes to the mainstream, as you cited. So talk about it, big picture, the Great Derisking. Why is this occurring now? And what do you see as the big risks that used to exist that were keeping people on the sidelines that is allowing people to say, oh, I don't have to worry about that stuff anymore?
Yeah, you can go way back as far as you want. One of the funny things about crypto is people always beat themselves up about not having bought crypto earlier, right? I've told you this story, Rick. The first time I encountered crypto was at ETF.com when we had an hour-long meeting in 2012 about Bitcoin when it crossed $1 for the first time, dollar parity day. It was in February of 2011, I mean. And I had an hour-long conversation. Did I go out and buy Bitcoin? No. Do I wish I did? Of course. If I put, $10,000 into Bitcoin at the time, I'd now have, I can't even do the math, $100 million or $1 billion or some absurd amount of money. It's easy to beat yourself up about that, but the reality was, if you go back to when Bitcoin was $1, the risks were endless, right? We didn't even know really that the technology would work. It had only been up and running for a few years. Maybe it would crash. There was nowhere to trade crypto. At the time, the largest exchange was a group called New Liberty Standard. And if you go to their website, the process was you would send money to a random PayPal address and they would send you Bitcoin 48 hours later. And the terms of service said, this is legal as far as I know. There were no custodians at the time, right? The largest custodian was Mt. Gox, which subsequently collapsed. There were no institutions who owned crypto. There were reason to believe regulators would make crypto illegal. There was a huge amount of criminal activity in Bitcoin, and there was a risk that the government would just ban it because they wouldn't want it to compete with the dollar. If you fast forward to today, the reason I talk about this theme of the great de-risking is now all of those risks, Rick, have gone away, right? Bitcoin has been up and running for 15 years with the best uptime of any financial service in the world. It's processed $125 trillion of value settlement without a single fraudulent transaction and 100% uptime for the last 10 years. That's better than Swift. It's better than Visa. It's better than MasterCard. It's the best in the world. It's secured by the largest supercomputing network in the world by a factor of about 10,000. It's extremely robust technology. Now we have publicly traded companies, S&P 500 members like Coinbase, custodying crypto, giant financial institutions like Fidelity custodying crypto. So we've de-risked from a custody perspective. When you go to trade crypto, you're now interfacing with firms like Jane Street and Susquehanna, not New Liberty Standard. The largest sort of market makers in the world are trading crypto. It has wide institutional adoption. We just covered JP Morgan, Morgan Stanley, Wells Fargo. 9 of the 10 largest hedge funds own crypto. Stan Druckenmiller owns crypto. Emory University owns crypto. And then most recently, we've really removed the regulatory and governmental risk, right? Now we have Bitcoin ETFs approved. Those aren't going to go back in the bottle. And now the US government even has a strategic Bitcoin reserve, which makes it, from my view, extremely unlikely that they're going to ban Bitcoin. And the incredible thing about this, Rick, now that we can buy Bitcoin in an ETF for 20 basis points with a qualified custodian, and it trades, at penny-wide spreads, is that the opportunity is still there. Bitcoin is still less than 10% of gold. So we have a huge amount of upside left, but we've dramatically de-risked Bitcoin from an existential perspective. I think it makes it the most attractive risk-reward opportunity in the market today. And I think the market is just catching up to the fact that we've dramatically de-risked what was a very risky investment when I first looked at it, and it was trading for $1.
There's a related issue to all of that, Matt, which is that in the beginning, go back to 2011, 2012, I got involved in 2012. It was entirely retail. And I think that remained the case even today. I would think if the dominant source of flows are retail investors. When you mentioned the statistics of the amount of tens of billions that have flowed into the Bitcoin ETFs that have been on the market now for about 14, 15 months, most of that flow has been retail, right? There have been some institutions buying those shares, but most of it retail. So what does that tell us about the state of retail versus institutional? And what do you see coming next? And how should advisors interpret that?
Yeah, I think advisors can see it as an opportunity to front run institutions, right? Retail investors are like speedboats and institutions are like tankers. So everything that I see tells me that the institutions are coming, right? So the flows are significant. If you look at the number of institutions, for instance, Rick, that report through 13Fs that they own Bitcoin ETFs, it started in Q1 of 2024 at 800. And then it went to 900, and then 1200, and then 1500, and then 1800, and then 1900. And it's on its way to 10,000, but it's going up in a straight line. It's just that institutions are very slow to move, right? These are slow moving institutions. I've said this before to you, Rick, but our average client meets with us 8 times before they allocate. If that's a retail investor, that could happen in a week, right? They text me, they DM me, they call me, they're incessant. And so they can allocate in a week. If it's a large institution, that's 2 years of quarterly meetings, right? And so I think what people should be thinking about is they have this fleeting moment that will be over someday where they're able to get in ahead of Jamie Dimon. When's the last time you could get in ahead of Jamie Dimon? Well, until yesterday, you could in Bitcoin, right? You couldn't in SpaceX. You couldn't in, the latest KKR fund, but you could in Bitcoin until yesterday. So you have this fleeting opportunity. It won't be here forever, but it still does exist for savvy investors.
And I guess that's part of the challenge for advisors from a mindset perspective. The fact that you are, can I add a word to you that you regard this as an opportunistic investment play?
Yeah.
And that isn't something that most advisors are used to doing. I mean, we aren't opportunistic. We instead believe in long term, that you almost a set it and forget it kind of approach, that we're going to buy an asset we can keep for decades. We'll rebalance along the way. We'll dollar cost average. We'll tax loss harvest. But we are not seeking opportunities that aren't going to last forever. And yet Bitcoin really is an opportunistic play that I don't know everything you've said so far today is something you'll say equally 50 years from now.
Definitely not. No, I don't think so. Look, I think alpha is one of the most fleeting things in the world. It's extraordinarily hard to find, right? I am a dyed-in-the-wool index investor. Jack Bogle, I wrote the foreword to Eric Balchunas's book on Jack Bogle. That is core to what I believe. But you have this opportunistic alpha in Bitcoin because the largest investors in the world have been kept out of it for reputational and regulatory reasons. Those are now being unwound, and you can be sure those investors are going to move in. That's what we see in the data. That's why ETFs are the most successful launch of all time for the ETF space, the Bitcoin ETFs. That's why the count of institutions allocating to them goes up every quarter. That's why Jamie Dimon has eaten his words and reversed course on Bitcoin, but you do have this opportunistic one-off chance. And absolutely, look, Bitcoin's going to be boring someday. And I don't know when that will be. It could be in 10 years, it could be in 15, it could be 20, but you won't have this opportunity. It's sort of a once in a generation opportunity from my perspective.
So that really forces us as advisors and investors to be really thinking about this differently and to recognize that this is a new innovative technology. It didn't exist 20 years ago. And just as we all missed the internet when it first came out in the 90s, this is an opportunity to not miss this one, which many, I've heard you refer to this as Internet 3.0.
I think it's of that scale. I think it may be, yeah, it's of that scale. It's the ability for money and property to move over the internet. That is a monstrous addressable market, right? Finance and money is really important, and it can't move on the internet without blockchains. And now it's all going to move on the internet over blockchains, and you have the ability to own those fundamental pieces. I do think it's like the internet in 1996, 1997. That's the stage that we're at. And if I, go back to my high school days, I wish I had allocated broadly to the internet and held for the last 40 years or whatever. I'd be pretty happy. So I do think that's the kind of opportunity we're looking at.
So elaborate for us about the institutional marketplace. You spend a lot of time in corporate boardrooms and with investment committees of endowments, pension funds, corporate, both public and private corporations. What's the sentiment you're seeing and hearing? What do you see is their focus or what's driving their demand?
Yeah, it's actually shockingly bullish. I'll tell you a fun fact. I spent last week traveling between TradFi and crypto conferences. I was in Vegas at a major regional broker-dealer conference, and then I went to Toronto to a crypto conference, and then to Miami to a retail investing conference. And of those three, the most bullish was the TradFi conference.
Wow.
They all actually see this train coming. They're just getting the ability to allocate to it. But they look at an asset that they and their peers need to invest money into that's only so big. And they're really excited about it. They see the supply demand characteristics. They've just been unable to allocate, or it wasn't worth the risk. And again, the risk has come way down. So I do think they're lining up to make their allocation soon.
You made a reference earlier that Bitcoin only represents about 10% of the value of gold. You've talked in the past about digital gold as a reference to Bitcoin. I hadn't heard that phrase recently, but it has like kind of reemerged. So talk about, do you still feel that Bitcoin is digital gold? What's your premise for all of that? Do you see any evidence that others are sharing that viewpoint in the institutional marketplace?
Yeah, I think that's the main way people are thinking about it. The other reason, aside from the supply demand characteristics, that we see so much interest in Bitcoin right now is we see rising concern about debt and deficits and the debasement of the dollar. And you have people looking for ways to hedge that. Just this morning, KKR put out a note saying US Treasuries are not the safe haven that they used to be. Well, if that's true, how do you hedge US Treasuries taking on risk characteristics? You can move into gold or you can move into Bitcoin. Bitcoin and gold are fundamentally very similar. They're scarce assets that aren't controlled by a government or any institution and can be used to store wealth in a way that no one can directly take it from you. That's what ties them together. I think Bitcoin is actually better than gold. It's more scarce. It's more easily fungible. It's harder to fake. And you can move it around the world at a push of a button. You can store it in your head and walk around with it. That's not true of gold, which is physical and big and bulky. But even if you disagree with me and say they're just equivalent, or Bitcoin is half as good as gold, the market right now is 10 to 1 gold to Bitcoin. And so I think, a core thesis that I and others have is Bitcoin is going to equalize closer to gold's market cap. And it's absolutely what I hear from leading financial advisors and institutions around the world. They see Bitcoin filling this role. They see the world going more digital. In a digital world where people want a version of gold, many of them are going to end up in Bitcoin.
Bitwise does an annual study. It's one of the landmark pieces of research in our industry on what the advisory community is thinking and doing in the field of crypto. You've been publishing this data annually for a number of years. I'm doing this off the top of my head, so I'm gonna get these two data points wrong. You'll correct me, but thematically, I think I'm in the ballpark. Uh, it's all well and good for everybody to express enthusiasm about this. Um, and we know from your research as well as ours and others that about half of financial advisors say they personally own Bitcoin, but only about 10 to 15% are actively recommending it to clients. And the number one reason that advisors explain the disparity, why they personally own it, but they're not recommending it, is that their firms won't let them. Compliance hasn't said yes, or the ETFs aren't on the platform approved by their firms. So talk about regulatory clarity or lack of clarity that we have and what the advisors ought to be paying attention to right now. Are my numbers roughly correct in the first
Your
place?
numbers are exactly correct. And, that's been verified. When I go and give a speech at Barron's top teams or top advisor conference, I always ask the room, how many of you can buy Bitcoin ETFs on behalf of clients? And still to this day, it's less than half the room. The majority of the largest investors in the world, which tend to work at these large firms, whether wirehouses or large broker dealers or even large independents, are just slow at turning on exposure to these Bitcoin ETFs. It's an incredible fact, but a really important one. But I do think that that will switch over the course of this year. I do think by the end of the year, they'll have the opportunity to allocate. But I loved your framing. There is a really important thing for advisors to consider. I think there's a huge amount of anchoring bias in the Bitcoin market. One of the reasons I ran through that story about how different Bitcoin was when it was $1 is that, this is not your grandfather's Bitcoin. It's changed completely. It's now an institutional asset owned by the largest hedge funds and pensions and endowments in the world, owned by multiple governments, that you can custody in a qualified custodian and buy in an ETF. Our ETF BITB charges 20 basis points a year, half the cost of GLD. And so what I would encourage advisors to do is to sort of re-underwrite Bitcoin. If the last time you looked at it, or if in your head you're still connecting it with Silk Road or Mt. Gox, those stories are now a decade old, and you should be connecting it with BlackRock and with Fidelity and with Bitwise. And I do think it's just a different asset than it was in the past.
You made a reference earlier about 2011, 2012 that we all wish we'd bought at $1. And that is a common objection or lament. In fact, in my white paper, as you know, I wrote a paper just a couple of months ago on the 6 big myths that are preventing advisors from recommending Bitcoin. And number one is it's too late. You touched on this a little bit, but Bitcoin is once again pushing toward its all-time high. It's around 105 as we speak here today. Its all-time high is 108. It was only a month ago that it was 75. So once again, is it legitimate for an advisor to say, I missed it? Or better yet, I should wait to go back to 75 before I buy it? Talk about that whole market timing, lamentation, expectation thing.
Yeah, the limitation thing is funny because I go to these rooms, I ask these questions, ask for a show of hands, and I'll ask people, do they think they missed Bitcoin? And sometimes the majority of the room will raise their hands because it's gone from $1 to $100,000, so they feel that they missed it. And then I'll ask them how many have clients with allocations to Bitcoin. It'll be like 10% of the room. Those two facts can't be true, Rick, at the same time.
Right.
Until the majority of the room's clients have allocated to Bitcoin, you're definitionally early, right? These are the people who control Americans' wealth, and the vast majority of their clients have no exposure to Bitcoin. I've said before, 95% of Bitcoin is already owned, but 95% of wealth hasn't bought Bitcoin yet. Those two forces are going to collide. So you don't look at the price versus the day someone bought a pizza with Bitcoin. It's completely irrelevant. You can't be late until the majority of your peers have an established allocation to Bitcoin in their accounts. And that's just not where we are right now, right? When we get there, Bitcoin will be $1 million. And when Bitcoin's $1 million and the same size as gold, we can say like we're probably at the end of the beginning. Now let's see how it competes with gold.
Do you want to put a timeline, a date on that $1 million?
I mean, our view is Bitcoin's going to get there in the next 5 years. So by actually the next 4 years, we said by the end of 2029, we think Bitcoin could get to $1 million. And I think that's the end of the beginning, Rick. I think gold parity is where Bitcoin enters its mature phase. And that's assuming gold's price stays where it is as well, which has been a bad assumption. It's been going up, so the target should be going up.
That makes sense. So let's put that in context. Bitcoin's 100,000. You're saying 1 million over the next, the rest of the decade. That's a 10x increase, 1,000% gain. Compare that to Goldman Sachs that says the S&P is going to grow 3% a year for the rest of the decade, as opposed to 1,000% over the next 4 years. So my point is that we need, as advisors, to, again, going back to that opportunistic conversation, we need to rejigger our brain cells into how we think about this. Because one of the objections that I hear, and this is also in my white paper, is that advisors say, I don't recommend Bitcoin because I don't speculate. I guess my argument is that a zero allocation is a bigger speculation than a small single digit allocation. Talk about that.
That's exactly right, right? Global equity is a $115 trillion market. Bitcoin is a $2 trillion market. If you're at zero, you're off benchmark, right? So, I mentioned I'm a Jack Bogle style investor. Your starting point should be owning the world's assets. Bitcoin is one of those assets. It's actually the fourth or fifth most valuable asset in the world after gold and a handful of individual companies. Then you get to Bitcoin. So if you're at zero, it's akin to having zero exposure to NVIDIA or zero exposure to Apple or zero exposure to, Meta or zero exposure to gold. Maybe you want to be that person, but you should know that you're taking an active bet against it. If you're neutral on Bitcoin, you should be 1 to 2% of your portfolio. If you're positive on Bitcoin, you should be looking at 5+% of your portfolio. I think there's a good argument to be made that Bitcoin can de-risk your portfolio because you can lower your weight to other risky assets, add Bitcoin, and then add more stable assets as well. But it is really important to note that it's now part of the conversation. It's 2% the size of the global equity market. You should probably get a 1 or 2% allocation just to be at base level and then go from there.
Okay, so let's talk tangibly from a strategic or practical perspective. First, explain to the financial advisor who has not yet added Bitcoin to client portfolios, what's the first move you would tell that advisor to make this quarter?
Yeah, the first move would be to have a conversation with your client. You may be surprised. They may already have Bitcoin that you can bring into your account, right? You can bring it on book and begin charging a fee. They may want to have a discussion with you to know that you're sizing it appropriately, that you're aligning with other major institutions. But the first step would be to talk to your client. And then from an allocation perspective, Rick, I think there are good arguments to be made of dollar cost averaging into Bitcoin as a way of reducing behavioral risk. In other words, if you're going to make 1% allocation, maybe chop that up over a number of months. The math would tell you you should do it all at once. That's what the math says about dollar cost averaging in any asset that tends to go up over time. But from a behavioral perspective, I think there's some advantage because it's still a volatile asset. It could pull back 10 or 15 or 20% in any given couple week period. So I'd say have a conversation and then think about your allocation size. And maybe if you're going to do it, dollar cost averaging is a good way to start.
So what do you do if you are that advisor whose firm has not said yes to the Bitcoin ETFs? Are you unable to allocate it in any way, or is there some other way you can still get an exposure?
No, there's some great proxies, right? So there are large and growing class of crypto equities that give you highly correlated exposure to the price of crypto and general exposure to the asset. So we have 2 ETFs. One is focused on crypto equities called BITQ. One owns companies that put crypto on their balance sheet, like MicroStrategy and 21 and MetaPlanet. That's OwnB. And that's good proxy exposure if you need to gain exposure to this market through companies as opposed to owning the assets directly. Those are both pretty attractive areas of the market today.
And those are just thematic ETFs, just like you would have an airline ETF or a manufacturing ETF. This is just thematic. So it's probably already on your firm's platform.
Almost all platforms allow exposure to those ETFs, even those like Vanguard that have been objectively anti-crypto. You can typically get exposure through the equity market. In fact, in an irony, Vanguard is one of the world's largest holders of MicroStrategy stock.
Go figure. We're getting a lot of questions from folks. Let me try to tackle some of these. Corey and several others have asked about Donald Trump's strategic Bitcoin reserve. Tell us about the status. Is it likely to happen? How much do you think it'll hold? And so on.
Yeah, absolutely. First of all, I think it's a very big deal. As I mentioned, one of the existential risks to Bitcoin was that the government would ban it or seize it from its private citizens because they saw it as a threat to the dollar. I think the fact that we have now established a strategic Bitcoin reserve that exists today and holds about 200,000 Bitcoin in it is a major step to de-risking that. I think the big questions on everyone's mind is, will the government add to its Bitcoin holdings? I think they will sometime in the next year or so. The executive order establishing that strategic reserve, Rick, said that the secretaries of Commerce and Treasury shall investigate ways to add to their Bitcoin position in a budget neutral manner. And I know there is work going on in DC to do just that. The US government owns something like 15% of all the world's gold, huge position in gold. I think there's a strong argument that it should diversify that exposure to include Bitcoin. I'm glad that the strategic reserve exists. I think it will grow in the future. And we're already seeing other governments around the world build their own positions in Bitcoin, whether that's the Abu Dhabi Sovereign Wealth Fund, which continues to accumulate Bitcoin via ETFs, or whether it's, Bhutan, which is using mining with its excess power to build up Bitcoin reserves. I do think this is a trend that's gaining traction in the market.
And let's not forget the states. 28 states have bills pending in the legislatures to add their own state reserve. And I think two of them, New Hampshire and somebody else, have already passed those bills into law.
Yeah, that's exactly right. Yeah, Anthony Scaramucci calls it a decentralized approach to Bretton Woods 2.0, which I like that framing. But yes, you're seeing this around the world. Look, Bitcoin is becoming a mainstream institutional asset, and that means companies are owning it, governments are owning it, states are owning it, pensions are owning it, financial advisors are owning it. All of the data point in this direction, and I think the world is sort of waking up to that reality.
Which kind of argues that it's inevitable you're going to have it in the portfolio. Just kind of like, you could have bought Amazon in 99, not too many people did, but today everybody owns Amazon. So it's probably inevitable that it'll be in the portfolio. The only choice you're really making is the price at which you'll begin to buy.
That is exactly right. Yeah, Jamie Dimon kept his folks out from $0 to $100,000, and he's decided that's the dividing line for him, and others will follow beyond that. But I think your framing is exactly right.
We all know that there's a finite amount of Bitcoin. You mentioned that 95% of it or such has been mined already. This question is related to that. When will the last Bitcoin be mined, and what happens when that happens?
Yeah, absolutely. The last Bitcoin will be mined sometime around 2140. We have 115 years, Rick. So it's going to be a while. I know you're into longevity, but that's a very long time to plan.
Yeah, even I won't see that.
But it is an important question of what happens then. The reason it's an important question, of course, is that the miners who maintain the network, who process transactions and secure the Bitcoin network, are compensated largely because every time they settle a block of transactions, they get a little bit of new Bitcoin, right? Every block gets a little over 3 Bitcoin, a couple $100,000, and that's the incentive that keeps the wheel going. So the question is, what happens when that incentive runs out? The incredible genius of the Bitcoin white paper is it planned for this. If you think of a block of Bitcoin transactions, it can only hold so many transactions. It's finite, the amount of block space. Let's say it can hold, for the purposes of argument, 100,000 transactions. and it settles every 10 minutes. But if there are 101,000 people who want to do a Bitcoin transaction, the way you make sure that your transaction gets processed first is you append a tip to your transaction. It says, if you settle my transaction, I'll give you $1 worth of Bitcoin, or I'll give you $10 worth of Bitcoin, or if it's really important, I'll give you $100 of Bitcoin. So the idea is that as the issuance of new Bitcoin reduces, so as that reward given to miners by new Bitcoin, the Coinbase reward, to use the term, reduces over time, the amount of this transaction or tip revenue will increase over time. And that's actually what we're seeing in the market, where transaction revenue now accounts for 10 to 20%, and eventually it will be 100%.
I guess an analogy might be that the taxi driver doesn't charge you anything because they're making money with ads, but when the ads go away, they're going to start charging you per mile.
That's a good example. The beauty is it's already built into the system, which I just think is exquisitely clever. And we're seeing that transaction take place even now.
One of the other common concerns people raise, we talked about the fact that people worry it's too late. Another one is that people worry there's no effective way to value Bitcoin to justify the price someone ought to pay for it. So talk about that whole question. What is Bitcoin worth?
Yeah, I think you can look at that from a short or a long-term perspective. In the short term, Bitcoin's price is set by marginal supply and demand. That's why we've been talking so much about this supply and demand fact. We know the amount of new supply, again, is 165,000 Bitcoin. Last year, ETFs bought 500,000 Bitcoin, and surprise, surprise, the price went up. So I think from a short-term perspective, you can really look at short-term supply-demand flows, and you can explain a lot of the price. From a long-term perspective, you have to look at the market that Bitcoin is going after. Look, Bitcoin provides a service to the world, the ability to store wealth in a digital format without a bank. I think that this market that service serves is at least as big as the gold market. You can think of gold as providing a service, which is the ability to store wealth in a physical object. Bitcoin provides the same service in a digital format. I think they're probably the same size market. The gold market is a $23 trillion market. There'll only ever be 21 million Bitcoin. You can do the math in your head and you end up at a price target slightly above $1 million. I think when you think about gold, Bitcoin providing that service, it really solves this valuation problem. How big is the market for this service? How many Bitcoin are there? Simple math gets you to a price target, and then you can decide how long it will take us to get to that level.
You know, in my book, The Truth About Crypto, I spent an entire chapter describing valuation models. And what you just said is a whole lot more eloquent and, would have taken about a page instead of a chapter. So good for you. We've talked pretty much entirely here so far today, Matt, about Bitcoin. But one of the big claims to fame for Bitwise is the fact that you guys created, and you alluded to it in the beginning, you mentioned it, you created very early on, I think it might have been the first product or one of the first products you created, BITW, the Bitwise 10 Crypto Index Fund, which is kind of like the S&P 500 of crypto. It's the 10 largest digital assets by market cap. It's not an ETF. We're getting a bunch of questions from folks who I'm willing to bet own it. I've owned it since the beginning as well, still own it today. And the big question is, when will it shift from its current status to that of ETF? So elaborate for everybody, explain what BITW is, how it works, the fact that it's not an ETF, why you want to make it an ETF, and so on.
Yeah, absolutely. It's my favorite product of ours, and one that I've owned for 7 years or whatever, and continue to own to this day. So as you mentioned, it's the world's first and largest crypto index fund. It holds the 10 largest crypto assets, weighted by market cap, while screening out assets with significant binary risks. As an example, we're very proud of, Rick, Luna, the stablecoin, became the fourth largest crypto asset, but it never entered our index because we identified its risk and avoided it for the portfolio. So broadly speaking, it's a market cap weighted index of crypto. I love it because crypto is a general purpose technology, be used for digital gold, be used for real world assets to move around the world. It can be used for stable coins. Different assets serve different markets. And I just want to bet on crypto. It's like going back and betting on the internet instead of choosing between Ask Jeeves and Yahoo. while missing out on Google. So I love the product. Because of regulatory restrictions, the way we were able to bring it to market in a ticker is through a OTCQX traded trust. People on the call might be familiar with GBTC, which was in a similar structure and is now an ETF. The challenge with that structure is there's a fixed number of shares, so it can trade at a premium or a discount to its net asset value. And BITW is traded at large premiums and at large discounts. It's currently at a small discount to its net asset value. We've been working to uplist it and turn it into an ETF, which, were we successful, would have, I believe, ETFs do this historically. ETFs tend to track their NAV exceptionally well, and will also allow us to make the product more cost effective. We're waiting to hear from the SEC. We have a live filing, so I can't say whether or not they will, say yes or no. But the filing comes up for its final review this summer, and we're hopeful to get this into an ETF format and on the market.
You mentioned the tracking error, which is important whenever in every asset class. If you own a stock ETF, you want to know that the share prices are tracking closely to the actual share prices of those stocks. So that's a question that someone has posed. How close is the ETF correlation to Bitcoin's price? How's the tracking error?
Yeah, basically perfect. So on the Bitcoin ETF and on Ethereum ETF, all they do is own Bitcoin or Ethereum in cold storage. And so what we've seen is that the price during the time that the ETF is trading tracks perfectly to the price of Bitcoin. It's of course worth noting, Rick, ETFs trade market hours, 9:30 to 4. And so if Bitcoin moves after hours, then the ETF has to catch up the next morning. But over any meaningful period of time, we've seen, approximately perfect tracking in not just our ETF, but other ETFs as well.
One of our attendees who's anonymous has observed that you have said, well, let me back up. We all know about the Bitcoin halving. You alluded to those block rewards that occur, and you said right now it's 3 1/8 is the reward people get. That gets cut every 4 years by half. And Bitcoin, you have cited, typically follows a 4-year cycle, 3 up years, 1 down year. This person is saying that you have recently offered commentary that you think the 4-year cycle is dead, and they'd like you to elaborate on that.
Yeah, so you have to think about first what causes the 4-year cycle, Rick. And there are various theories, but the two dominant ones are this Bitcoin halving effect, which happens every 4 years, which cuts the amount of new supply in the market in half. And then interest rates, which have tend to follow incidentally since Bitcoin's creation, something like a 4-year cycle, with interest rates going up to 5% and then crashing down to 0. I think the 4-year cycle may be over for 2 reasons. One, both of those forces are reduced, right? Every time we do a halving, the effect of the next halving is half as much. And so compared to like 3-4 year cycles ago, the amount of Bitcoin we're cutting in a halving is really relatively marginal, right? We're only growing supply at 0.8%. Before we were growing at like 5% a year. So when you took that to 2.5, that's a huge supply shock. Now, if we take it from 0.8 to 0.4, yes, it still matters, but it matters a lot less. And the same thing is true from an interest rate perspective, at least according to forecasts. We were ping-ponging between 0% interest and 5% interest, this ridiculous wild swing. Now we're talking about maybe it's 4.25, or maybe it's 4, or maybe it's 4.5, but we're nibbling at the edges. So the scale of that force is much smaller. So I see the forces that drove it historically dramatically reduced. And at the same time, we have this tidal wave of institutional exposure, right? We have trillions and trillions of dollars of wealth that is for the first time getting exposure to Bitcoin. And as we just talked, it's a tanker that's slowly turning around towards Bitcoin and is gathering force. And so when I think about the forces that have historically caused the 4-year cycle being diminished, and then the forces that are driving new demand for Bitcoin being larger than they have in the past, I just think it'll be unlikely that we follow that pattern in the future. It doesn't guarantee that we won't follow it, But I think a logical argument says, sort of why would we, right? I think things have actually changed. It's always scary to say this time is different, Rick. But I do think the logic tells you this time is a little bit different.
I think what you're saying isn't that we're not going to see price declines anymore, which we used to see once every 4 years. You're
Right.
saying it might not come with any particular regularity or predictability.
That's exactly right. We haven't banned volatility or pullbacks. I'm not saying that at all. We're not in a super cycle where Bitcoin only goes up. I'm just saying that this Olympic style quadrennial drawdown is maybe an artifact of the past.
John's asking if we're going to see a Solana ETF this year.
Oh, I hope so, John. I don't know. That's another one where Bitwise has a live filing with the SEC amongst others in the space, and we're waiting to hear. Look, the SEC is much more engaged and open to conversations, but obviously we can't guarantee anything will launch until we see it launch. But we have a better shot today than we have at any point in the past.
Talk about these three, Solana, Ethereum, Bitcoin, juxtapose them, contrast, compare. I mean, Ethereum's price has not moved nearly as much in the last year as Bitcoin's has.
Yeah.
Solana's getting a lot of attention as a replacement for Ethereum. Put all the three into context.
Yeah, I think you could think of it as a tree. So they're all crypto assets, Rick. Bitcoin is primarily focused on being money or gold, right? So it's a monetary asset. And I don't really think it's competing with Ethereum and Solana. Ethereum and Solana are programmable blockchains. They're programmable, decentralized computer space. And I think their primary use is going to be moving other assets than Bitcoin around the world. Dollars, stocks, bonds, etc. I think we're likely moving into a world where the majority of the world's assets move over programmable blockchain rails like Ethereum and Solana. So the first fork is Bitcoin is gold. It doesn't really have a competitor. And Ethereum and Solana are programmable blockchains. And they're competing directly with each other. They just have slightly different theses on the best way to build a programmable blockchain. Solana is more centralized and fast. Ethereum is more decentralized and a little bit slower. And the market is figuring out which of those two they like. Obviously, you know what I'm going to say. I own them all. There's that Jack Bogle in me. But that's the way to think of it, is really it's Bitcoin, and then it's Ethereum and Solana, and they're going head to head for relatively similar markets.
I own them all as well. Lauren is asking, relative to your comment earlier about strategy as a proxy for owning Bitcoin, he's asking about the miners as a proxy. So talk about that idea.
Yeah, Bitcoin miners have a relatively high correlation to Bitcoin, but it's not perfect. They're increasingly not quite as pure play as they used to be because they tend to have some overlap in the AI and high performance computing space. But look, I think they're great businesses. That the average miner is mining a Bitcoin now for something like $40,000 to $50,000, and they retail for $100K. That's a pretty good margin. I do think you can be selective in the mining space. I think some are better positioned than others, but it's a category that we love. It's an important part of BITQ, our crypto equity ETF. It's an important part of the ecosystem. I think there's lots of reasons to be long-term bullish, but like any sector, there are good miners and bad miners, and an expert may try to tease those out.
So it's another illustration. There are a lot of different ways you can own crypto and engage in this space. And the diversified indexer is going to do a little bit of everything.
That's right.
Be directionally correct, and you'll avoid being precisely wrong, as Warren Buffett would say. We have just a minute or two left, and I think one of the most fundamentally important questions that we never seem to tackle was submitted today and said, if you're new at this, what can you do to get basic information to see even if I'm interested in the first place?
Oh, wow. I'm going to talk both our books, Rick. DACFP is one of the foundational places for learning about crypto. All the members of our distribution team at Bitwise go through the DACFP certification program. So I'm not just saying that to be nice. We really believe in the educational content. that you provide, Rick. I think that's a great place. And I would say on the other side of my spectrum, I co-authored the CFA Institute's first ever guide to Bitcoin, blockchain, and crypto for financial professionals. It's available for free to download. It's relatively short, about 60 pages. And I think it's held up pretty well, even though I wrote it 4 or 5 years ago. So those are good starting points. But just by being on this call, I think you're taking a good step as well.
And that's really the key, is to spend time learning about this stuff before you really begin to invest. It is new and different, and it is something that is remarkably easy to learn. I think people get intimidated about it because it seems so different, but look, if I can comprehend it, so can you. So I appreciate the shout out, Matt. Michelle has done a great job for us. Go to the chat here on the Zoom link. Michelle has provided links to Bitwise's latest crypto market survey of advisors, which is 70 some pages of unbelievable data, all of it current. Also, my white paper you'll find there, which has the 6 big questions that people are asking today, including one that we didn't have time to get to, Matt, which is, will quantum computing pose a threat to Bitcoin? I answer that question in this white paper as well. And also, another great place you can get a deep dive is by coming to Vision, which is our annual crypto conference. This is June 9 to 11 in Dallas. This is the oldest, longest running crypto conference exclusively for investors and financial advisors. We've got Senator Bernie Moreno as our keynote. Catherine Molinar, one of the first pension funds to buy Bitcoin, is in this event. I also encourage you to access, as Matt said, our CBDA program and become certified in blockchain and digital assets. You'll learn an awful lot about this, and if you're an advisor, you'll get 18 CE credits along the way. And my book, The Truth About Crypto, which, like Matt, was published a few years ago. His book was for CFA, but still holds up and gives you a lot of great content and information that'll be of value to you. So a lot of great ways for you to get the information you need to find out what this is, how it works, and most importantly, what's going on right now, so that you can be of greatest value to your clients. Matt, as always, it's a pleasure to be with you. Terrific content. We encourage you to contact Bitwise. You can do so at bitwiseinvestments.com. Tremendous amount of content and resources there, and their national network of folks who will be happy to come visit with you, no matter where you are, to get you the information you need on this space. Matt, always a pleasure to be with you.
Thanks for having me, Rick. This was a lot of fun.
We'll be back here again with you for another event coming up. Be sure to stay in touch with us, and we're happy to help. Thanks, everybody. Have a great day.